Hello, everyone. So, today we are going to talk about non current assets held for sale and discontinued operation about Ind AS 105. When you look at Ind AS 105, the purpose of this standard is to help companies account for situation when they intend to sell non-current assets, not the current assets, right? Current assets are anyway are getting liquidated in the normal course of business, right? So we'll understand what's the meaning of a non-current asset. That anyway, I'm sure all of you know, which is what has been defined under Ind AS 1 as well. To say if you have a non-current asset which is held for sale, right, which you intend to sell, what does that mean? That you no longer intend to use it in the normal production process for the or for your administrative purpose to in a way generate future economic benefits. So you believe as a company that I am actually better off by realizing the benefits by selling this asset in the marketplace as opposed to using this asset on an ongoing basis. So that's one element of what we need to understand, which is non-current asset which is held for sale. Now, many times what happens that the size of the asset group which you intend to sell are very large, right? They either represent a major line of business or geographical operation or the entire subsidiary which you had acquired with the purpose of resale, etc. So in a way, it represents a sizable portion of the business, and hence it is important to then label them as discontinued operations. In a way, that portion of business you don't intend to continue in times to come. And why this is again important is because, let's say, if I am a shareholder of that company, then I need to know that what is it I will have access to continuous set of cash flows, continuous profitability, or the balance sheet strength, etc., versus what this company was doing historically. Because if this piece of business is going to go away, I will not have access to the set of cash flows in relation to that piece of business. And if that is sizable in nature, then the accounting standard expects you in a way to identify them, present them, disclose them separately as discontinued operations. So we will try and understand that this standard also in a way provides you certain measurement guidance. So similar to every other standard we've been talking and learning, we'll focus on the scope, we'll focus on the recognition principles, the measurement principles, and then the disclosures and the presentation. All of that is what we will try and understand as we progress. Important standard, we don't see application of this on an ongoing basis to many companies, right? Because companies don't just buy assets with the intent to resell, right? With the intent to in a way dispose them. So, or if you're in the anyway business of buying and selling asset, then it is not a held for sale or a discontinued operation. That's a normal business, let's say real estate company, right? They want to they build houses and then they sell them, so on and so forth. So that's not something which is covered under Ind AS 105. Ind AS 105, what is covered is that you are using a set of asset group in the production process or for administrative purpose. Now you intend to in a way sell it off. You no longer intend to use it for your own operations, from that perspective, or it is of such size that it actually fits in to be classified as discontinued operations. So we will try and talk about all of that. So some of the key things which we need to in a way pick up as to what is non-current asset held for sale. So we'll quickly refresh our memory in terms of the definition of the non-current asset, which is nothing but to say that whatever is not a current asset is a non-current asset. What's the meaning of the disposal group? That's a very, very important perspective here, because whatever forms part of the disposal group, that in a way gets classified as held for sale. And how do you define discontinued operation? We will talk about it. What's the criteria for classifying existing asset as held for sale? So can you classify anything and everything as held for sale, or there are actually defined criteria? And this is very, very important in a way to understand, so that there are certain conditions which needs to be met before you classify a disposal group as held for sale, and we will try and understand all of those conditions. Possibly you'll have to also visualize, remember some of those concepts for your better understanding. How to measure non-current assets, right, which are classified as held for sale. So we will also understand that how do you measure the non-current assets which are classified as or the disposal group, right? You will hear this term disposal group time and again during this conversation, right? So how do you measure the non-current assets which are classified as held for sale? How to present and disclose non-current assets which are classified as held for sale and discontinued operation. Okay, so the presentation element is extremely important as part of this standard. And in fact, we have an example of a real life a listed company situation, and we will talk you through as to how that's in a way been presented in that company financial statement, pretty much at the as we kind of progress towards the end. Okay, we will talk about that as well. So all in all of these important concepts. So what is a non-current asset held for sale? What's the disposal group? What's the discontinued operation? How do you look at the measurement? How do you look at the presentation? What are the criterias you need to meet to classify something as held for sale? All of that is what we intend to discuss and understand. So looking at reflection on the examination trends, that's very important for us. As I see here, and twice in November 19 and November 18 is when this has been picked up, right, for in a way test, which is 8 to 10 max, which is not a small sum, right? It's at almost 10% of the syllabus. So important for you to understand. And the best part is that the concepts are not complex here. Okay, it's fairly easy. There's only one measurement principle, right? There's only one measurement principle, and there are only I would say there are 5 to 6 conditions which you need to possibly keep in mind to assess that is this something now which meets the criteria for held for sale, right? So one measurement, and then there are few in a way related principles. All of that is what we will talk about, but it's a fairly simple standard. To my mind, it's a fairly simple standard, not a complex one. But key is for you to remember some of these, guidance or some of the principles to the standard, because some of that is not very intuitive. Okay, some of this is not very intuitive. You got to follow a principle, right? That's the important stuff. Okay, so let's talk about the scope of the standard. Okay, and similar to as I've been talking, whenever you look at the scope of the standard, something which has been covered in any other standard, you got to follow that standard. Is something which is not been covered, but purpose of this standard, that's where you in a way come in and in a way deal with the accounting and reporting, and that is what we will try and understand here as well. So the objective and scope, non-current assets which are held for sale are presented separately from other assets in the balance sheet. So the key here is that the asset groups which are non-current asset held for sale are required to be presented separately. It's a separate disposal group which needs to be presented as part of your balance sheet disclosures. That is extremely important. And the value will be principally recovered through sale rather than through continuous use in operation of the entity. So you intend to now sell this. You don't intend to continue for production process, or you don't intend to in a way use it even for administrative purpose. You intend to sell it, right? Monetize the asset, right? That's the objective here. The standard specifies the accounting for asset held for sale. That's the very important thing, and that's the measurement guidance which is out here, which is measured at lower of its carrying amount or fair value less cost to sell. Carrying amount immediately prior to this being classified as held for sale. Okay, you got to compare the carrying amount immediately prior to this being classified as held for sale with the fair value less cost to sell. Okay, the lower of the two is the recognition, is the measurement amount under the standard. And if there is any difference between the carrying amount immediately before classification of this as held for sale and the fair value less cost to sell. That means if the fair value less cost to sell is lower than your carrying amount, then that difference is also charged to the profit and loss account. Now, if that difference is high, if in a way, if fair value less cost to sell is higher, then there is no immediate accounting impact. You're not allowed to record an unrealized gain, right? Under the standard, only the unrealized losses are required to be recorded immediately. Depreciation on such asset is going to cease. So since you no longer intend to use this asset for the purpose of production or administrative, the principle in the standard suggests that you're no longer supposed to record depreciation, okay, on such assets. So that's a very, very important. So these are two very important, in a way, measurement guidance, which is out here, which is very specific to this standard, which we need to remember. Now, results of discontinuing operations. Remember, not all disposal group which are held for sale are going to qualify as discontinued operation, okay? But if it qualifies also as a discontinuing operation, and we will talk about that, it should be then separately presented in the statement of profit and loss, as it affects the ability of the entity to generate future cash flows, which is what I said, right? That I, as a shareholder, will no longer have access to this set of cash flows, right? On an ongoing basis for a foreseeable future on a going concern basis. And hence, this has to be presented separately. This has to be presented. In fact, you have to compute EPS for discontinued operations separately, because I will no longer have access to these earnings, on a foreseeable future. This standard also specifies the presentation and disclosure of discontinued operations, non-current assets held for sale, and all disposal groups of an entity. All right, and we will again try and understand this in very detail, right? In a great degree of detail, for you to fully understand, appreciate, and be confident, right, about your understanding of this standard. All right. Let's quickly talk about that. What are the things when we talked about this measurement guidance, which is not to be covered here, right? So what's not in scope, right? The measurement provision of this Ind AS, Ind AS 105, okay? The measurement provision of this Ind AS do not apply to the following assets, right? What are those following assets? Deferred tax asset, which is covered by Ind AS 12. How do you measure deferred tax asset under Ind AS 12, right? Which is, you look at probability, right? Which is defined as more likely than not, that whether an asset is likely to be realized or not. That's a probable approach. You don't look at fair value less cost to sell. You look at probable approach, right? And hence you're going to get guided by that standard. Assets arising from employee benefits. How do you measure assets under Ind AS 19? You measure asset under Ind AS 19 for defined benefit plans, right, using a projected unit credit method, which is a statistical model followed by actuarial techniques, right? So you don't follow fair value less cost to sell, and hence the measurement principles of Ind AS 105 are not applicable to deferred tax, are not applicable to employee benefits, are not applicable to financial assets, right, under Ind AS 109, because under Ind AS 109, you follow like fair value, right? You follow fair value, right? And there's a detailed guidance which is available under Ind AS 109, which I'm sure all of you have by this time must have understood or going through. Non-current assets which are measured at fair value less cost to sell in Ind AS 41. So if there is a guidance under Ind AS 141, you got to follow that guidance, all right? And then contractual rights under insurance contracts as defined in Ind AS 104, which is the insurance contract. So I think the point I'm trying to make here is that if you have a specific measurement guidance under a specific standard, right, which is to say that Ind AS 12 for deferred taxes, Ind AS 19 for employee benefit, Ind AS 109 for financial assets, Ind AS 104 for insurance contract and Ind AS 41 for agriculture related items. All of that are, you don't need to follow the measurement principles of Ind AS 105 as far as it relates to the disposal group, right? Or the assets which are forming part of the disposal group. And we will again try and understand this lot more, right? With help of examples. Of course, we have lots of examples for we to talk about. Okay. Now, let's try and understand the definition of non-current asset. What's the definition of non-current asset? Okay. So now the way the non-current asset has been defined in the standard are assets that do not meet the definition of current assets, right? So non-current assets are those assets that do not meet the definition of current assets. So now, what a current asset essentially, right? A current asset is something an entity classifies an asset as current when they're part of the normal operating cycle. Okay, it expect to realize the asset or intend to sell or consume it in its normal operating cycle. That's an important point. It holds the asset primarily for the purpose of trading, buying or selling. It expects to realize the asset within 12 months, from the date after the reporting period, or the asset is a cash or a cash equivalent, unless there is a restriction on the utilization of such cash or cash equivalent from that perspective. So when you think about this, what is it we are trying to say? Non-current asset held for sale. So there has to be a non-current asset which is forming part of the disposal group, right? And now what is a non-current asset? An asset which is not a current asset. Now what's a current asset? A current asset is something which you expect to realize, right, within your normal operating cycle, or within 12 months, or which you are doing frequently buy and sell, or if it is cash or cash equivalent, so on and so forth. So we need to keep in mind so essentially what is left here, right? If you think about it, what is left here? Ordinarily property, plant and equipment, right? That's one big item which is like a non-current asset. Then your intangible assets, right, which is there. Then many times your investments, right, which is out there, they're also in a way a non-current assets, right, because you don't intend to realize them in next 12 months, and they're not part of your operating cycle, etc., etc. So whatever you see as part of your working capital, your cash or cash equivalent, or things which you intend to realize within next 12 months, all of them are in a way are current in nature. Everything else is non-current, and you got to have a non-current asset forming part of the disposal group for you to be accounting this as part of Ind AS 105. So now we will try and, so we've understood what is non-current asset. Okay, now we will try and understand what is the meaning of disposal group. Okay, so when we think about disposal group means that a group of assets which must have at least one non-current asset as forming part of that group. Okay, so group of assets which has one at least non-current asset, group of asset which has at least one non-current asset, right? One non-current asset which is forming part of this group, plus associated liabilities, right? Whatever the directly associated liabilities, both in a way put together, you intend to held for sale, that is called as disposable group. That is called as disposable group. In a way, from that perspective, it's a single transaction. In a single transaction, you intend to in a way dispose them of. Yes, if carrying amount, when they're going to call as disposable group, when you intend to recover principally through sale. When you intend to recover it principally through sale, that is what it is being called as disposal group. All right, group of assets which has at least one non-current asset, right, plus associated liabilities which are held for sale, they called as disposal group, right, to be recovered principally through sale, in a way from that perspective. Okay, now let's try and understand what's the meaning of discontinued operations. So far we've talked about what's the non-current asset held for sale, what's the non-current asset asset. Then we've talked about a disposal group, if it is the if or a non-current asset, which is a group of assets of forming part of the disposal group, okay, which you intend to sell in a single transaction by way of third party transaction. We've also understood some of the scope related exceptions, right? Some of the scope related from a measurement perspective. Let's try and understand what's the meaning of discontinued operation. As I said, all disposal group which are held for sale, all of them are not to be classified as discontinued operation, okay? But some of them may be eligible to be classified as discontinued operations as well. So what potentially is required additionally for them to be classified as discontinued operation? So what's a discontinued operation? A discontinued operation is a component of an entity. So remember Ind AS 108, right? Segment reporting, right? A discontinued operation is a component of, and also, we do some of this goodwill impairment testing, right? Under Ind AS 36, and again at a component level, right? Where you have discrete financial information. What is the meaning of component? Which are CGUs, cash generating unit, right? A discontinued operation is a component of an entity that either has been disposed of or is classified as held for sale and represents a separate major line of business or geographical area of operations. In a way, I'm just kind of letting go of that set of customers, right? That set of potential cash flows. If that been the situation, right, then it sounds like it's a discontinued operation. Otherwise, it's a business as usual. Okay, you decided to sell something. Good luck to you. Go and sell, right? But don't call it as a discontinued operation. For you to call it as a discontinued operation, it has to be a disposal group which is held for sale and which represents a separate major line of business or geographical area of operations, or is part of a single coordinated plan to dispose of a separate major line of business or geographical area of operations, or a subsidiary which is acquired exclusively with a view to resell, right? A subsidiary which is acquired exclusively with a view to resell. Now, a disposal group is a group of assets to be disposed of by sale or otherwise together as part of a single transaction, and liabilities directly associated with those assets that will be transferred in a transaction. Okay, so what's a discontinued operation? Discontinued operation is something which is a non-current asset which is held for sale, or a disposal group which is held for sale or is already being disposed of, which represents a component of an entity, and that is of such size and nature that essentially it's a separate major line of operation or a geographical area, right? Separate major line of business or geographical area of operation, or is part of a single coordinated plan to dispose of a separate major line of operation or business, right? Or a geographical area, or is a subsidiary which is acquired with a view to resell. That is what is called discontinued operation. And we've understood what is a disposal group. And what's the component of an entity? Again, as I said, go back to Ind AS 108 or Ind AS 36. We've again talked about the same concepts. A component of an entity is nothing but which comprises operations and cash flows that can be clearly distinguished, right? Discrete cash flows, that's what we call them. Do I have discrete cash flows which have no dependencies on other set of cash flows of my other businesses, right? So this can easily be carved out, this can easily be reviewed in terms of performance. So it's like a profit center, right? What is a component is like a profit center, right? Distinguished operationally and for financial reporting purpose from the rest of the entity, a cash generating unit or a group of CGUs, while being held for use. All right. So what's a discontinued operation? Let's take an example here. Okay. All right. Entity X operates a retail chain. It decides to sell one of its outlet located in a prime location in the city. However, entity X will continue to run 100 other outlets in the city. Okay. Now, what does this mean? All other Ind AS 105 criteria for held for sale classifications were met at 1st of July 2020. Now, what is the criteria? First, it has to be a non-current asset forming part of the disposal group plus directly associated liabilities. They are held for sale. That forms part of a disposal group, and we will learn that what are the other important criteria which are required. Assuming all of them are met, the outlet will be sold in March of 2021. Okay. Now, entity X management believes that outlet is a discontinued operation and wants to present the result of outlet as discontinued operation from the date of classification, okay, from 1st of July 2020, right? Now, you are selling one outlet out of 100 other outlets you have in the city, right? So, but the management believes it's a discontinued operation. The question here is analyze whether entity X management analysis is correct or not. Okay, entity X management analysis is correct or not, right? What do you think, right? So, I mean, it looks very simple to me, right? Because you are saying that I've got 101 retail outlets in a city. Out of that, I'm going to sell one good prime location. So what? But you're not this does not represent a separate major line of business or a geographical area of operations. Now, if you were to tell me I'm going to dispose this all the outlets I have in the city, then I can possibly think that, is this represent a major geographical area of operation? And but in this situation, I think the fact patterns are fairly simple to say that this is not a discontinued operation, even though it's a disposal group, even though it will qualify as held for sale, it is not a discontinued operation. So let's go through the solution here. All right. What's the solution saying? A discontinued operation is a component of an entity that either has been disposed of or is classified as held for sale. So component means where you have discrete cash flows. So one can argue that this store has discrete cash flows, right, which are independent of, let's say, other stores' cash flows and so on and so forth. But does it actually, and it's an and condition, does it represent a separate major line of business or geographical area of operations, or is part of a single coordinated plan to dispose of a separate major line of business or geographical area of operations, or is a subsidiary acquired exclusively with a use with a view to resell, right? So it forms part of a disposal group, no doubt about that, but it is not a discontinued operation, right? Why? Because it is a single outlet and does not represent a separate major line of business or geographical area, nor it is a subsidiary acquired with a view to resell. I hope this is clear to all of you. I'm hoping this is fairly simple, right? You have 101 outlets, you intend to sell one that may qualify as a disposal group, that may qualify as a component, but it does not represent a separate major line of business or a geographical area of operations, or is not is a subsidiary which is acquired with a view to resell, and hence it's not meeting the definition of discontinued operation, and hence it's not a discontinued operation. So now we will try and understand that when you look at classification of a non-current asset as held for sale, okay, so what are the things which, and then when you classify them as held for sale, what do you need to do immediately? There are measurement principles, so there are recognition principles. We're going to focus on the recognition principles, and then we're going to focus on the measurement principle, right? So what are the criteria which you need to look at, and the once you met those criteria, then what's the measurement? Is that lower of its carrying amount or fair value less cost to sell, and you going to see the depreciation. Any more depreciation on of that will immediately be stopped. Okay, so let's look at the classification as non-current asset as held for sale, which is a disposal group, right? Carrying amount to be recovered principally through sale. Okay, and there are detailed criterias, right? So the first thing which needs to be met is that if the carrying amount will be recovered principally through a sale transaction rather than through continuing use. So that's one in a way condition, that you as management decided that I'm going to sell this and I'm going to recover this rather than through continuing use. Okay, so what else I need to worry about? Okay, so when you look at the requirement for classification of an existing non-current asset as held for sale, okay, in a way there are two key requirements, all right, which we need to worry about. One is that it has to be available for sale in present condition. That means, let's say if you want to sell a building, right, the building is available for sale in present condition, right? If you want to sell a plant and machinery, the plant in my factory, for example, right, that has to be available for sale in its present condition. It's not that I need to do take 5 more approvals and this or that, if there are approvals required, there has to be customary approval which is required to enable the sale, right? From that perspective, and sale must be highly probable, right? Remember, all of these criteria under Ind AS 37, right? On contingencies that we have remote, right? Which is, I would say, between 20 to 30%. We have possible, right? Which is 30 to 50%. Which we have probable, which is more likely than not, more than 50%. Then we have highly probable, right? Which is more than 70, 80%. Then we have virtually certain, which is like more than 95%. Then we have certain, right, which is like 100%. So these are different levels of probabilities, right, estimates, which are being used from an accounting perspective, like a judgment. Okay, so what are the two very, very important criterias? First of all, it has to be a non-current asset group, right, which is to be which the management intend to now monetize through sale and not by way of continuing use. And the second is that it has to be available for sale in its immediate present condition. So wherever it should be available for sale immediately, and the sale is also likely to be highly probable. Okay, highly probable. So that means 70-80% probability that you will be able to locate a buyer and you'll be able to complete the sale process in a reasonable period of time. And the reasonable period of time is defined as, again, 12 months. All right, so it's available for immediate sale in its present condition. Okay, and that's the important thing. So the asset must be available for immediate sale in its present condition, and the asset cannot be classified as a non-current asset if the entity intend to sell it in a distant future. That means it has to be sold in near future, and the near future is generally defined as, in a way, 12 months. That you should be able, sale is highly probable and you should be able to realize this over next 12 months. Okay, let's take an example, right? Building A is used as headquarters by company Z, and company Z intends to sell the building, and before it can be sold, building A needs to be vacated, right? Which is reasonable. The time required to vacate the building is usual and customary for sale of such assets. Therefore, in this scenario, the criteria for classification as held for sale would be met, right? Because I'm the current occupier, but now I intend to sell it. But if you intend to sell it, I need to vacate it. But there are no, in a way, other conditions attached to my ability to vacate it. I can just, there's nothing which is, important stuff which I need this building for, and hence I can, in a way, exit out of this building as and when I have a buyer and I'm actively looking for a buyer, and I believe that the sale is highly probable in a way. So the classification as held for sale would be met. Now, if I have to change the fact pattern slightly, okay, however, if building A is to be vacated only after a replacement is available. Now you've added a condition, my friend. Okay, now if only after a replacement is available, then this may indicate that the property is not available for immediate sale, but only after the replacement become available. That means it's not available for immediate sale, right? But only after the replacement become available, right? So then you can't classify this as held for sale. Just remember, there should not be any condition, which is just making it difficult for you to, in a way, get out of this property. There could be conditions, but then there has to be customary and usual, right? For that kind of property. So anything which is not customary, not usual, then that in a way puts a challenge for us to say that, can I really classify them as held for sale? Is it really available for sale in its present condition, right? Is the sale is then highly probable, right? Do I expect that the sale is likely to be completed in next 12 months, right? From that perspective. So that's the important criteria. So let's looking at another example, right? P Limited intend to sell a manufacturing facility. However, before the sale, P Limited needs to clear a backlog of uncompleted order. Now, if I need to clear a backlog of uncompleted order, the facility cannot be considered as held for sale. I cannot classify this facility as held for sale. Now, assuming that P Limited, let me just clear this up. Assuming that P Limited intend to sell the manufacturing facility along with the uncompleted order, then the facility can be classified. That means if I can sell it along with the uncompleted, then of course there's no problem, right? Then it is then it can be. But if I cannot, I have to first complete the uncompleted order. That means it is not available for sale in its present condition. The present condition is available for sale only when I have completed all the backlog orders, right? So you got to be very, very careful, on some of these fact patterns, right? Now, N Limited intend to sell its building, Taj Square. However, to fetch a higher price, N Limited would like to renovate the building before selling it to a third party, right? I would like to renovate the building before selling it to a third party. Although N Limited is already searching for a buyer at current market values. Okay. But due to the plans to renovate the building before the sale, the building Taj Square may not meet the condition of available for immediate sale because I intend to renovate it. I don't know how much time it will take, right? So those information is not available. Since you intend to renovate it, first renovate it, right? And then only you can classify them as held for sale. Now let's look at another situation. K Limited has put a plot for sale. Okay. Prospective buyer, before making an offer, shall undertake searches and valuation, right? Which is usual, right? Undertake searches and valuation for the plot under sale. Any delays that might arise from carrying out such legal processes do not preclude the plot from being classified as held for sale, because this is a customary and usual requirement for this plot to be sold, right? So there is no restriction here, then it can be classified as held for sale. But in this case, you can't, right? Not eligible. Okay, not eligible. Why? Because I am doing, and this is eligible, right? And in this case, we saw there are two variations, right? Two variations. One is eligible. The upper one is not eligible, but this one is eligible, right? So depending upon the fact pattern, your answer is going to change, and hence we got to be very, very clear on the fact pattern, right? And then we're talking about sale must be highly probable, right? What does that mean? Okay, the standard defines highly probable as significantly more likely than probable. Okay, more likely than probable. And what is the meaning of probable? Probable means more likely than not. So it has to be more likely than probable, right? Where probable means more likely than not. Ind AS 105 describe following 5 conditions. Now these 5 conditions are important, right? Following 5 conditions to be satisfied for the sale to be qualified as highly probable. You need to remember these 5 conditions, right? That's my recommendation and request to all of you, that you got to remember these 5 conditions, right? Management must be committed to a plan to sell the asset. So I, as the management, must be committed. So I own this property. I intend to sell this. So I've committed a plan with the requisite authority, right? So I am the decision maker. Let's say in this case, maybe a board of directors, maybe a decision maker. They have taken a decision that now we want to sell, and it has to be, let's say, a formal decision they have taken. Management must be committed to a plan to sell the asset or a disposal group. Active program to trace a buyer and complete the selling plan must have been initiated. So I've started actively looking for a buyer, right? Either I'm doing it myself or I've appointed intermediaries to find me a successful buyer or interested buyer, etc. Asset must be marketed for sale at a reasonable price, right? If I believe the price of this is 100, right? I'm not asking 1,000, for example, right? You can ask for 110, that's okay, but you got to be selling it at a reasonable price, right? A price at which you can possibly, you more likely than probable of finding a buyer, right? Sale is expected in 1 year, which is what I was saying, 12 months, okay? Is expected in 1 year from the date of classification as held for sale, may be extended in certain circumstances. Okay, it may be extended in certain circumstances. So 1 year is a kind of a check, but not it's a rebuttable presumption. Let me put it that way. 1 year is a rebuttable presumption. You can rebut it in limited situations. All right. And action suggests significant changes to a withdrawal from the plan is unlikely. That means it's not that today I'm going to classify this as held for sale and tomorrow I'm going to say, no, thank you very much, I no longer intend to sell this. So that's an unlikely scenario. It may happen. It may happen. Its standard is not saying that it's not that you may not change your mind. You can change your mind, right? But it is unlikely at the point in time you decided to designate is as held for sale. So what are 5 criterias? That management with the requisite authority, right, has agreed to a plan to sell the asset. Okay. Second, right, you are running an active program to trace the buyer. There's an active program is there to trace a buyer. Third, asset must be marketed at a reasonable price. You expect to complete the sale in next 12 months and you don't intend to go back on your words, right? It's highly unlikely, all right? 5 criterias. 5 criterias is what you need to look at before you classify an asset group or a disposal group as asset which is held for sale. And remember, just because you're going to classify this as held for sale does not mean it is a discontinued operation. Okay. Now, a discontinued operation needs to meet more criteria, which is to say it has to represent a separate major line of business or geographical area of operation, or it's a subsidiary acquired exclusively with a view to resell. Then it may also classify as a discontinued operation. Okay, but for the purpose of classification as an asset group which is held for sale, remember it has to have an asset group which has to have a non-current asset and associated liability which is held for sale, and that forms part of disposal group. And for this to be classified as a disposal group, it has to meet 5 conditions, right? Management has to approve the plan. You're actively looking for the buyer. Your price expectation is reasonable. You are unlikely to go back on your words, and you expect to complete the process in next 12 months. All right. Let's look at some of the other relevant points. Okay, now if you're selling a subsidiary, right, if there is a loss of control in a subsidiary, an entity which has committed to a sale plan which involve loss of control of a subsidiary shall also classify all the assets and liabilities of that subsidiary as held for sale in the consolidated financial statements, right? When the criteria set out above is met. What are those 5 criteria, right? That the management has approved the plan, the sale is likely to complete in 12 months, you're actively looking for the buyer, you're looking for the buyer at a reasonable price, and you are unlikely to change your mind. Okay, good. So if those 5 criteria are met, okay, you can classify them as held for sale. And same goes for when I'm going to lose control over my subsidiary, right? Now, we talked about this 12-month criteria. The 12-month criteria is a rebuttable presumption, right? So there could be certain exception, right? An entity can classify an asset as held for sale even if the time frame of 1 year to conclude the sale transaction has lapsed. Okay. Now, for this, the delay must have been caused by the event or circumstances which are beyond the control of the entity, and there must be sufficient evidence that the entity is still committed to its selling plan. So the reasons like COVID happened, right? Now, if COVID happened, so everything, all plans went for a toss, okay? But I still intend to continue to sell it. So possibly this can be argued that this was a situation which was beyond my control, right? And hence I should continue to classify such disposal group as held for sale, right? And now if you classify them as disposal group as held for sale, what is it you need to do? Measurement guidance is lower of carrying amount or fair value less cost to sell. And of course we'll pick it up, right, with a lot of examples and a lot more deliberation on the principle, and the depreciation also will stop. You will cease to provide more depreciation from the date you classify that as the asset group which is held for sale. Okay, let's look at some more perspective on this exception to the 1 year period with the help of an example. So what is this example saying? Okay, Best Group Limited, a large business, has correctly classified property as held for sale, considering its commitment to sell a manufacturing facility in its present condition. However, after a firm purchase commitment and the buyer inspection, some environmental damage were identified. Okay, some environmental damage were identified which was not previously known to exist, right? Now I am required by the buyer to make good the damage. Okay, I am required by the buyer to make good the damage, which will extend the time frame to complete the sale within 1 year. So it may require, but I have a buyer, I have a firm commitment. However, Best Group has initiated action to make good the damage, and satisfactory rectification is also within my control. I should be able to fix the environmental damage. In this situation, exception to 1 year requirement will be met, right? It will be met. All right. Even if a sale include exchange, that I'm going to exchange one non-monetary asset for another non-monetary asset, which involves commercial substance, that also in a way meets the criteria for classification as held for sale, right? A sale transaction includes exchange of non-current assets for other non-current assets when the exchange has commercial substance. Remember, exchange has to have commercial substance in accordance with Ind AS 16, property, plant and equipment. Okay, let's talk about some of the other relevant points. What we're looking here, asset acquired with a view to a subsequent disposal. We in a way talked about in this context of a subsidiary, right? When the asset acquired is a non-current asset exclusively with a view to subsequent disposal, the non-current asset is classified as held for sale at the acquisition date only if, when, right? Only if you acquired an asset with a view to resell, you will classify them as asset as held for sale at the point of acquisition itself. Okay, if the 1 year requirement is met and it is highly probable that any other criteria which is not met at that date, okay, which is not met at that date will be met within a short period following the acquisition, usually is 3 months. Okay, usually is 3 months. Okay, so what are the criteria which needs to be met? You remember, right? 5 criteria, right? What were those criteria? That management with the requisite authority has committed to a plan to sell the asset, right? Now I've started actively looking for a buyer, right? I am marketing this expecting a reasonable price, right? And I intend to, it is possible to complete the process in next 12 months, right? And I'm unlikely to go back on my words. Okay, I'm unlikely to in a way go back on this plan. Okay, so these 5 criteria. Now if you acquire a non-current asset and you intend to sell it within 12 months, right? In a way, you're then trying to look at short-term market opportunities, and you have a view that this asset, I suspect if somebody is going to purchase an asset and sell it at a loss, right? That means you expect that this asset possibly should go up, and hence that's the reason I want to do it. So standard is saying, okay, if that be the case, what does that mean? That you don't intend to use it for the purpose of your operation, right? You intend to actually profit by way of selling it. So, okay, so you can then possibly classify that as held for sale, right? Provided, you'll be able to sell it in next 12 months and all other criteria already, which is expect to, you appointed somebody to, in a way to look at it, or you started actively marketing it, you're expecting a reasonable price and you're unlikely to change the plan. All of the other criteria are also met usually within 3 months. Okay, let's look at this with the help of an example. Beta Limited has acquired property Z solely with a view to sell. Okay, the management is highly confident that the property Z can be sold in 1 year. Now, property Z requires refurbishing it to enhance its value, which is highly probable to be completed in less than 3 months, right? Now, in this case, you can possibly classify this as a held for sale, right? Remember, in the previous example, when we talked about that, if something which you intend to sell, but you need to renovate it, then you don't get a classification. Okay. But here you acquired something with the purpose to resell, right? And you need to do some refurbishment, which you expect to complete in 3 months. So in a way, this is a slight deviation in the standard itself to accommodate a unique situation for purchase of certain non-current asset, which you intend to sell within 12 months, right? And hence you can classify them as non-current assets, which are held for sale, okay, which are available, which are held for sale, right? Classified as held for sale on the date, even though it is not immediately available for sale in its present condition. That means I intend to refurbish it. So it's a slight, in a way, deviation, and that's why, as I said, some of these principles are not intuitive, so you may need to possibly just kind of try and understand why are we saying this, right? And just kind of get this, internalize some of these concepts, right? Let's try and reflect on a few other points. Okay. So if there are criteria which are met after the reporting period, okay, which is like a subsequent event. Okay. So I'm on 31st of March reporting year. And now, let's say on 10th of April, I taken the decision that this asset group I intend to classify as a held for sale. The question is then, do I need to do it on 31st of March, or it's a subsequent period? It's an adjusting event. So whenever you think about, after the reporting period, the first thing, in a way, which comes to our mind, is it an adjusting event, right? Or a non-adjusting event? Okay, adjusting event or a non-adjusting event, and that's where it is a non-adjusting event. Okay, a decision subsequent to the reporting period is a non-adjusting event. Okay, if the criteria of held for sale are met after the reporting period but before the date of authorization of the financial statements, a non-current asset should not classify as held for sale. That means it's a non-adjusting event, right? But it's an important, in a way, event. So it's a disclosure event, right? When those criteria are met after the reporting period but before the approval of the financial statement, the entity shall disclose the information in the note. So it's a disclosure event. Okay, it's a disclosure. We will not do any classification or measurement related changes, but we will only disclose that in the financial statement. Classification as held for distribution. So similar, in a way, principles. An entity shall classify, let's say if I intend to distribute a set of asset group which I have to my promoters or shareholders. So an entity shall classify a non-current asset as held for distribution to its owner on parallel line, as discussed above, required for classification as held for sale, right? So that also is, in a way, akin to disposal, right? I'm going to dispose by distributing. So I'm no longer going to use it for the purpose of my business. Okay, for the purpose of my business. All right. So non-current assets to be abandoned. Okay, non-current assets to be abandoned. That's the difference, right? One is that there are three ways you are using your asset, right? Either you are using it or selling it, or you're going to abandon it. That means essentially, you just going to discard it, right? Now, if they're non-current assets to be abandoned, they're not held for sale. Remember that, okay? Non-current assets that needs to be abandoned will not qualify to classify as held for sale because the carrying amount will principally be recovered through continuing use in the entity operation rather than through the sale, right? However, if the disposal group to be abandoned meets the criteria as prescribed in Ind AS 105 to be classified as a discontinued operation. Now, it's possible that an abandoned group may classify as a discontinued operation. Then you need to look at the presentation for discontinued operation. When it will be met? When it represents a separate major line of business or geographical area of operations, or is a subsidiary which is acquired exclusively with the purpose of sale, right? So if you meet a criteria that even though I'm going to abandon this, it will not meet as held for sale, but it may still meet the criteria as a discontinued operation. I would say it is extremely rare for an asset group which you intend to abandon. That means you're not able to monetize, and it is still that relevant in your scheme of thing that it represents a separate major line of business or geographical area of operation. Looks to me extremely rare situation. Non-current assets to be abandoned include non-current assets that are to be used to the end of their economic life, and non-current assets that are to be used that are to be closed rather than sold, right? All of that in a way are covered here. All right. So I'm just going to take a pause here. Thank you. And so now we will deal with an example, right? Temporary ceases to use a plant. Okay. So Star Limited ceases to use its manufacturing plant because demand for its product has declined. However, plant A is maintained in a workable condition and it is expected to be brought back into use in future when the demand picks up. So the question is that can you classify this as held for sale, or it is like just in abeyance, right, or abandoned for the time being, but I'm maintaining it, so I intend to use it, right? So the plant A is neither to be treated as abandoned nor as held for sale because its carrying amount will be principally recovered through continuous use. Okay. Now, the Star Limited shall not treat the plant A as held for sale, and neither it shall stop charging depreciation in its books because the carrying amount of plant A will be recovered principally through continuing use to the end of its economic life. Okay, that's an important example. So now we will talk about measurement related principles. Okay, measurement, and I said that measurement means there are two important principles you need to remember here, and those principles are lower of carrying amount. Okay, lower of carrying amount or fair value less cost to sell. Okay, and you will stop charging depreciation, right? Stop charging depreciation from the date it is classified as held for sale. Okay, so let's look at measurement at the lower of carrying amount and fair value less cost to sell. An entity should measure a non-current asset classified as held for sale at the lower of carrying amount and fair value less cost to sell, right? As lower of carrying amount and fair value less cost to sell. If a newly acquired asset, right, which is, let's say I've acquired with the purpose to resell, it will be measured on initial recognition at the lower of its carrying amount had it not been so classified, and fair value less cost to sell. Okay, so extremely unlikely that if you when you purchase it, right, and that in a way is an evidence of fair value because that's the transaction value. So essentially you will end up classifying this as carrying value, it's extremely unlikely, right, that you will have a further markdown, but possible. In some scenario, it is possible, right, depending upon the circumstances under which you had to do that kind of a transaction. Okay, so it will measure initial recognition at the lower. Again, the thing is, it is still lower. Okay, I think this is important for us to look at. It is lower of its carrying amount. Okay, it is not higher. Okay, lower. So unrealized losses are to be recorded, unrealized gains are not allowed to be recorded. Hence, if the asset is acquired as part of a business combination, it will be measured at fair value less cost to sell, because that's where you do the all the measurement guidance under Ind AS 103. Now, before the initial classification of the asset is held for sale, the carrying amount of the asset has to be determined with reference to the other relevant Ind AS, and most likely you end up applying Ind AS 36, right, which is an impairment standard, right? So as per other applicable Ind AS. On subsequent remeasurement of a disposal group, right? So you've done the initial measurement, which is lower of cost, carrying value, or fair value less cost to sell. Okay, now and you stop providing for the depreciation, right? The subsequent measurement, now we're talking about the subsequent remeasurement. If it is there's a continuous decline in the value, then you will continue to record that as lower of carrying value less or fair value less cost to sell. If there's a further decline, you're going to record that further unrealized loss, all right, to be recorded through the P&L. Okay, so that's the important thing, right? So the carrying amount of any asset or liabilities that are not within the scope of the measurement requirement or Ind AS but are included in a disposal group classified as held for sale should be remeasured in accordance with the applicable Ind AS. And remember, what were those things, right? We talked about it, right? Say deferred tax, say financial assets, right? Employee benefits, right? We talked about insurance assets, right? Insurance asset under 104, employee benefits under 19, financial asset under 109, deferred tax under Ind AS 12, and then also we had agriculture assets, right, which is under Ind AS 41. So if anyway you were measuring all of this, when you're doing a measurement, there are carved out, you're going to follow that in a way principles, right, of respective standard to continue to in a way fair value them. All right. Measurement at the lower of carrying amount and fair value less cost to sell. Remember, depreciation shall be immediately stopped from the moment the asset has been classified as held for sale. Okay, depreciation has to be immediately stopped. Now, interest and other expenses will continue, right? Attributable to the liabilities of a disposal group classified as held for sale, so it will continue to be recognized, right? Because I have to pay to a third party. Okay, so you got to continue to recognize. The accrual concept will continue, right? Only the depreciation, amortization stops. Okay, when the sale is expected to occur beyond 1 year, the entity should measure the cost to sell at the present value. If there are, let's say, transaction costs, then there could be some discounting element, which again go with the principle we follow under Ind AS 37, right? All of that you got to discount it to the present value. Increase in the present value of the cost to sell from the passage of time shall be presented in the profit and loss as a financing cost, Now, non-current asset classified as held for distribution are also measured on same line as non-current asset, which are classified as held for sale. We've already talked about it. Okay, let's talk about this with the help of an example. Measurement prior to classification as held for sale. Okay, so what's the fact pattern we have here? Space T Limited owns a property, and it was stated at the following amount in its last financial statements: 31st December 2020, INR 12 lakhs. Accumulated depreciation, INR 6 lakhs. Net book value is of 6 lakhs. The asset is depreciated at an annual rate of 10%, that is INR 1.2 lakhs per annum, right? 10% of 12 lakhs is 10%, 1.2 lakhs. Now, during July of 2021, so we have information as on 31st December. Now, during July of 2021, Space T Limited decides to sell the property, and on 1st of August 2021, it meets the condition to be classified as held for sale. Now, what are the conditions to be classified as held for sale? There are 5 conditions, right? Which is management has authorized it, right? I'm actively looking for a buyer, right? The sale price expectation is reasonable, right? I expect to complete the sale in next 12 months, right? And I'm not unlikely to go back on my plans, right? I got to look at 5 criteria, right? 5 criteria, assuming all of that has been met when? On 1st of August, right? Now you're required to analyze the depreciation impact for the property, all right? So what is our net book value as of 31st December 2020 is 6 lakhs. So we got to determine what will be the carrying value immediately before this being classified as held for sale. So in a way, I will provide for depreciation for how many months? 7 months, 5 plus 2, right? 31st July. So at 31st of July, Space T Limited should ensure that the property is measured in accordance with other Ind AS, which is Ind AS 16, and it should charge depreciation for the period beginning from 1st of January 2021 till 31st of July 2021, prior to classifying it as held for sale as per Ind AS 105. Therefore, as at 31st of July 2021, the property should be depreciated by further 70,000 INR, 70,000, and should be carried at INR 5,30,000 before it is measured in accordance with Ind AS 10. Price may be lower than your carrying value, right? So we will try and understand this with more examples, okay? So let's look at this example as held for sale. Now, Sky Limited acquired a property M for INR 2 crores. 2 crores. After few years, the carrying amount of the property M is of INR 1.2 crore. That means 80 lakhs being depreciated. And on that date, the property M is classified as held for sale under Ind AS 105 by Sky Limited. Now, fair value less cost to sell immediately upon classification is INR 1 crore. Okay. So multiple data points, 2 crore original cost, fair value, the carrying value immediately before classification of this as held for sale is 1 crore 20 lakhs, and the fair value less cost to sell on the date when you want to classify this is 1 crore. Now, at the time of classification as held for sale, property M will be measured at lower of its carrying amount, which is INR, compare INR 1.2 crore and fair value less cost to sell as INR 1 crore. Okay. Now, on initial recognition as held for sale, there is a write down. There is a write down of property M, and accordingly, property M is now going to carry at INR 1 crore. 20 lakh is an immediate loss, which I need to record in my profit and loss account as an unrealized loss. A loss of 20 lakh is recognized in profit or loss. Additionally, no depreciation should be charged from the date the asset is classified as held for sale as per the requirement of Ind AS 105. Now, on subsequent reporting date, now the property M fair value less cost to sell is estimated at INR 85 lakhs. This is a further drop in the value of the asset. Accordingly, I need to record additional loss of 15 lakh. And now the property M is carried at INR 85 lakhs. Okay, so I've recorded whatever 80 lakhs of depreciation. Then I've recorded 20 lakhs of write down, another 15 lakhs of write down, and I stopped providing for any depreciation. Now, subsequently, if you've been able to sell it for 95 lakhs, right, a gain of 10 lakh will be recorded in your financial statements in your P&L. So let's try and quickly recap what we've talked about. Non-current assets or disposal group. What are non-current assets? Let's say, what is non-current asset? Something which is not a current asset. And we talked about what is a current asset, something which is to be realized in your operating cycle, or you intend to do it in next 12 months, or you do it for the purpose of buy or sell, or it is not a cash or cash equivalent, or it's a cash or cash equivalent. So anything other than that is a non-current asset. So you got to form part of a non-current asset, an asset group which has a non-current asset plus associated liabilities which are held for sale. They are called as disposal group. A newly acquired asset can also be class, and then you know uh, uh, a newly acquired asset can also be eligible to be classified as held for sale if that is the intention, that you intend to realize this within next 12 months. And there is a slight degree of deviation in the rules, that here, even though the asset is not ready for sale in its immediate condition, only for a newly acquired asset, right? In that case, and that could be, let's say, 3 months. We talked about this with the help of an example like the refurbish asset, etc. Okay, all of that. So we need to understand. So asset acquired as part of a business combination to be measured at fair value less cost to sell. All right. Okay. So all of this is what we've talked about. Then we talked about the criteria which are required to be classified as held for sale. We said there are 5 criteria. We talked about the scope exception. We talked about the measurement principle. All of that is what we have picked up again with the help of several examples. We also understood the distinction between the held for sale and abandonment, and we also said if something is classified as held for sale, it is not necessary that that thing will also get classified as discontinuing operations. We also understood the definition of discontinuing operation to say that a discontinuing operation should represent a non-current asset held for sale, or is a component of a business, okay, which represent a separate major line of business or geographical area of operation, or is a subsidiary which is acquired exclusively with a view to resell. If that's been the case, in a way, it qualifies as a discontinued operation. Held for sale is a separate presentation. Discontinued operation is an additional presentation and disclosure requirement. All of that is what we have understood, discussed as part of this conversation so far. All right. So let's try and understand some more around the recognition of impairment losses and then their reversals, right? How all of that will play out. Okay. Now, we talked about impairment loss to be recognized for any initial or subsequent write down of the asset to fair value less cost to sell. Any gain, now this is important, now there's any gain on subsequent increase in fair value less cost to sell should be limited to the cumulative impairment loss that has been recognized either in accordance with this Ind AS or previously in accordance with the Ind AS 36 impairment of assets. So you can possibly reverse the unrealized losses which you have recorded, but in no situation you are allowed to record an unrealized gain. Okay. And we should also remember in Ind AS 36, we picked up this concept that once a goodwill once been impaired, you're not allowed to recover the value or rewrite the value of the goodwill, right? For disposal group, gain on subsequent increase in fair value to sell should be limited, right? In case fair less should be limited to the extent that it has not been recognized in the remeasurement of scoped out non-current assets, current assets, and liabilities, okay? But not in excess. It should be limited, not in excess of the cumulative impairment loss that has been recognized, okay? And we will try and understand some of this with the help of examples. How do you allocate the impairment loss? That's another important criteria, right? The impairment loss shall be allocated to the disposal group in the following order. First, you allocate it to goodwill. Then you Then all other assets group, all other assets are forming part of the asset group. You do a pro rata, but you got to be mindful that you shouldn't reduce it below its realizable value, right? For example, you don't want to allocate to cash, or you don't want to allocate it to account receivable, right? If you believe that this is realizable, because otherwise it results in a profit recognition in the next measurement date. So you got to be careful here, right? And we will try and understand this. Okay, so first, to reduce the carrying amount of goodwill allocated to the disposal group and then to other assets of the disposal group pro rata on the basis of the carrying amount of each asset in the group. Now, a gain or loss not previously recognized through remeasurement by the date of the sale of a non-current asset should be recognized at the date of derecognition. So when you're derecognizing, of course, if you're making money, then you should, of course, record it. Requirement related to derecognitions are to be dealt as per Ind AS 16. So when you actually want to derecognize, essentially when you going to relinquish the control, right? You're going to relinquish the control over that asset. That means I need to derecognize that asset under Ind AS 16 or under Ind AS 38. Let's take an example. Now, Ruby Limited has classified a disposal group as held for sale. All right. The disposal group consists of the following. Okay, with carrying amount before and after classification as held for sale consists of the following. So we have all the information here. We have goodwill, property, plant and equipment, building, inventory, investment in equity instruments, and then we have all the data here to say this totals up to 16 lakh. Carrying amount as remeasured before reclassification as held for sale is 14 lakh 90,000. That means this 1 lakh 10,000 anyway is measured as per other Ind AS to be recorded immediately as a charge in my profit and loss account. Okay, so that's first set of information which has been given to me. And then what are the additional information, right? So I'm going to record the loss of INR 1,10,000 should be recognized immediately before classifying the disposal group as held for sale, right? Now the additional information is fair value less cost to sell is, let's say, 13 lakh. Now I was at 14 lakh 90,000 and 13 lakh. That means another 1 lakh 90,000 of loss, which I need to record. The key we are trying to address it, how is this 1 lakh 90,000 is to be allocated, right, to all the assets forming part of that asset group, right? Now, impairment loss of additional 1 lakh 90,000 should be recognized at the time of classification as held for sale, and then subsequent depreciation amortization will be stopped. Okay. Now, inventory and investment, right, are measured as per Ind AS 2 and Ind AS 109 respectively at no more than their fair value at the date of remeasurement, immediately classified as held for sale. So impairment loss of 1 lakh 90,000 is allocated to goodwill, and then the remaining is allocated to other assets in the proportion of their carrying value, excluding that I don't need to allocate this to inventory or to other financial or to the financial asset, because they've already been measured as per Ind AS 109 or as per Ind AS 2. Okay, so let's just try and see how do we need to allocate this. So first we've got this 14 lakh 90,000. Okay, now I have another 1 lakh 90,000 which I need to allocate. So this goodwill I'm going to first write off completely. Okay, assuming I have still some more to allocate, which is 40,000. Now this 40,000 essentially going to get allocated among these two assets, which is property, plant and equipment and building in proportion of their carrying amount, right? If I were to allocate to inventory, just think about it. Tomorrow I'm going to sell it, then immediately there will be a profit, right? On the inventory. So essentially inventory is already carried at lower of cost or fair value, whichever is lower. So we're not supposed to further lower it down. Okay, that means the loss is not attributable to inventory, right? Similarly, investment in equity instrument measured at fair value, right? Under Ind AS 109. Okay, so again you don't need to do anything, it's already at fair value, right? So now that is where you allocate the impairment loss of this remaining amount of 40,000 into the same proportion, and then you get the revised amount of 13 lakhs. Let's just quickly just do the math here. This is Now it says that assuming at the end of the reporting period, the fair value less cost to sell is increased. Estimated now is 15 lakh 50,000. So it's actually more than 14 lakh 90,000. Okay. And the question here is, now we are at 13 lakhs. Now it has gone up to 15 lakh 50,000. So should I record this entire gain of 2 lakh 50,000, right? Now that's where it is important to remember the principle that goodwill, once impaired, is not allowed to be recovered. All right. That means how much was the goodwill in my example? 1,50,000, right? 1,50,000 was the goodwill. So goodwill I'm not allowed to recover. Okay. So what do? How much balance I'm allowed to, in a way, recover? Reversal of impairment loss is not allowed on goodwill, as it will lead to recognition of self-generated goodwill, which is prohibited. Therefore, the impairment loss reversal available to Ruby shall be limited to 40,000. That is the cumulative impairment loss, which is what I have recorded, which is 40,000. Okay, the cumulative impairment loss which I have recorded is only 40,000. The previous, otherwise there was no other information that there was an impairment loss which I have recorded under Ind AS 36, right? There was no other impairment which was recorded here. There was normal depreciation and other charges which were levied. So the total loss was 1,90,000, but that loss of 1,90,000, even though it's now fully recoverable, it was allocable to goodwill, and goodwill once charged off, you're not allowed to write it back. Okay, so the only thing which you can now write it back here is 40,000, right? Being the cumulative impairment loss minus impairment loss adjusted against goodwill, not allowed to be reversed. Okay. So let's quickly, in a way, recap. Recognize an impairment loss for any initial or subsequent write down of the asset to fair value less cost to sell. A non-current asset should not be depreciated, subsequent to this being classified as held for sale. And the reversal of impairment loss is not allowed on goodwill, as it leads to recognition of self-generated goodwill, which is prohibited under Ind AS 38, intangible assets. Okay. So now we are going to do one case study, which is an adaptation from November 2019 examination. Okay, so let's look at this question. On June 1, 2018, Entity D Limited plans to sell a group of assets and liabilities, which is classified as a disposal group. On July 31st, 2018, the board of directors approved and committed to the plan to sell the manufacturing unit by entering into a firm purchase commitment with Entity Z Limited. So June 1, you intend to sell, and on July 31st, you already have, you committed by entering into a firm purchase commitment. All right. However, since the manufacturing unit is regulated, the approval from the regulator is needed for sale. The approval from the regulator is customary and is highly probable to be received by November 30, right? That means within 12 months. And the sale is expected to be completed by 31st of March, 2019. Entity D Limited follows December year-end. The assets and liabilities attributable to this manufacturing unit are as under. So I have a net asset, goodwill, plant and machinery, building, debtors, inventory, creditors, loan of total of 5,500. Okay, amounts are in lakhs, right? INR lakhs. Now I did the carrying value assessment. Okay. Now carrying value as on 31st of July 2018 is 5,200. Carrying value as of 31st of July 2018 is 5,200. Okay. It is 1,000 of goodwill, 1,800 of plant and machinery, 3,700 of building, debtors, inventory, blah, blah. All of that is 5,200, right? As of 31st of July. So essentially, that's the date when I have the approval to, in a way, classify this as held for sale. Okay. Now, more information. What else I have here? The fair value of the manufacturing unit as on December 31st, 2017 is INR 4,000 lakh, and as on July 31st, 2018 is INR 37 lakhs, right? Fair value is INR 3700 lakh. The cost to sell is INR 200 lakh on both these dates. Okay. The disposal group is not sold at the period end. Okay, that is December 31st, 2018. The fair value as on December 31st, 2018 is lower than the carrying value of the disposal group as on that date. Okay, more information. Okay, more information. So on July 31st, the fair value was 3700. The cost to sell is 200, right? On both these dates. So the disposal group is not sold at the period end, that is December 31st, 2018. The fair value as on 31st December is lower. Okay, now look at what's the requirement. All right, assess whether the manufacturing unit can be classified as held for sale and reasons thereof. If yes, then at which date? Okay, so what are the reasons? Remember, right? There are 5 conditions to be fulfilled. Okay, then the measurement of the manufacturing unit as on the date of classification as held for sale. Okay, the measurement of manufacturing unit as at the end of the year. Okay, as at the end of the year. All right, all these 3 things I need to look at, right? So manufacturing unit can be classified as held for sale, possibly yes, right? Because those 5 criteria: management with the requisite authority, I'm looking for a buyer, I'm looking at a reasonable price, I expect to sell it, right? All of these criteria, and then how do I measure it? Lower of carrying amount and fair value less cost to sell, right? I'm going to also look at the measurement of the manufacturing unit as at the end of the year, which is December 31st, 2018. The information suggests that the fair value as on 31st December 2018 is lower than the carrying value of the disposal group as on that date. Okay, let's look at the solution. Assessment of manufacturing unit, whether to be classified as held for sale, right? Disposal group is available for immediate sale and it's in present condition, right? Expected to be received 1 year. So there will be 31st July at which management becomes committed to the plan. The sale is highly probable from purchase agreement. Sale is expected to be completed within 1 year. So all the criteria are in a way met, right? So this qualifies as to be classified as held for sale, right? Now let's look at the measurement of manufacturing unit as on the date of classification as held for sale, right? Following steps I need to look at. Immediately before the initial classification of the asset as held for sale, the carrying amount shall be measured in accordance with the applicable Ind AS. Okay, this has been done, and the applicable Ind AS, it has been determined as 5,200 lakhs. The difference between the carrying value as on 31st December and 31st July is accounted, which is basically charged to the P&L, right? Step 2, an entity shall measure a non-current asset classified as held for sale at the lower of its carrying amount or fair value less cost to sell, right? And what is that information? 3,700 and minus 200 is the fair value less cost to sell is 3,500. Okay, so lower than the carrying value of 5,200 lakhs, right? That means what? 5,200 minus 3,500. Okay, so we need to record how much? An impairment loss of 1,700 lakhs, right? An impairment loss of 1,700 lakhs, which first needs to be allocated to goodwill and then pro rata to the other, in a way, non-current assets forming part of that asset group. Okay, so how do I do this? When I look at measurement, so I have goodwill. So this was 5,200 as of 31st of July, and then I have to allocate this 1,700, which is nothing but 5,200 minus 3,500, which is what I just did, right? 1,700. So 1,000 first absorb the entire goodwill, write off, go home, goodwill go home, right? And then balance I'm going to allocate to plant and machinery and building. So I'm not allocate to anything, to debtors, to inventory, to creditors, or to loan. Try and see, this is measured as per 109. This is measured as per Ind AS 2, measured as per Ind AS 109, measured as per Ind AS 109. Okay, so and hence you don't need to allocate anything to these four asset items which I have. I will, or asset or liability which I have, I will only need to allocate this in the respective proportion, which comes to 3,500, right? And I'm going to cease the depreciation. Okay, now I'm going to look at some of the working notes here, right? So what's the working note, just for your reference here? So it suggests allocation of impairment loss to plant and machinery and building after adjustment of impairment loss of 1,000. The balance INR 700 lakhs is allocated to plant and machinery and building on proportionate basis. Okay. So last step, on 31st of December 2018, right? So this is how you've done the allocation, which is absolutely fine. Now, measurement of manufacturing unit as on the year end shall be on similar line, as because I don't have the information, right? That what is the subsequent decline. So we can't do much. The on the disposal group, not within the scope of the standard, are measured as per the respective standard. Okay, very well done. The fair value less cost to sell of the disposal group as a whole is calculated. This fair value less cost to sell as the year end shall be compared with the carrying value as at the date of classification as held for sale. It is provided that the fair value as on year end is less than the carrying amount. Thus, the impairment loss shall be allocated in the same way between the assets of the disposal group falling within the scope of this standard as shown, right? So here is more of a theory which I have to explain. Since I don't have the amounts, we are not being able to further allocate and compute the loss, as on the closing date. All right. So with this, I'm going to take a pause, and we will begin next morning. Thank you.